Joining us right now is WPP CEO, Sir Martin Sorrell. And Martin, it's great to see...
Another day of turmoil, is that what it's going to be?
I guess so.
We're up here in this Davos bubble,
right.
and the world's going to hell in a handbasket.
Exactly. So is that how you see it? I mean, or do you not believe these numbers?
Before the end of the year, I felt 2016 was going to be the same as 2015. I still sort of feel that. Our industry benefits from things like the Olympic Games, the presidential election, the European Football Championships, so what we call the Maxi Quadrennial. Every 4 years we get these Maxi events. Having said that, I think the mood here is a little bit depressing. But the world, as you know, Maria, is a slow growth world, no inflation, no pricing power, therefore a focus on cost. So I think clients are very, very cautious. You know, you saw our second largest client, Unilever, announce their results. They were good results, but they said, you know, 2016 is going to be a tough year. American companies are facing strong currency, the dollar.
Right.
They look at their reported results, and CFOs, I'm told, I spoke to one CFO who said they look at their reported results, they're cutting their costs in order to balance their profitability. So, I mean, it's illogical because you should look at it in constant currency, but having said that, they're reacting that way. So it's not a great environment, and we have all these geopolitical risks.
Yeah, and you know, when you look at the Eurozone, I mean, the economy here is getting better. And the ECB just announcing it's actually leaving rates unchanged.
Not a surprise.
Not a surprise, because people were not expecting necessarily an increase in stimulus right now.
Well, if they increased rates, we would see the market go down
even further. Obviously.
But the dollar strength. I mean, the pound has weakened, which actually for us is now a currency tailwind, because now the dollar strength outweighs the euro weakness, whereas last year it was the opposite. We had a headwind, or even though we thought we were going to get a tailwind last year. So the geopolitical risks, whether it's Brexit, oil, China, Middle East, Crimea, Ukraine, Russia, whatever, all these things add to the uncertainty, and there will be some black swans. There will be some things that even these brain boxes at Davos don't figure out. It usually happens that way, and we'll get caught out on. You
and I were on a panel yesterday, and I thought it got quite feisty between you and Paul Singer from Elliott Management. Let's talk about that for a second.
Well, I know you like to build it up to be fussy. What I said was... And
you said hedge fund activists pressure companies for short-term gain.
Are perceived to, I said.
Yeah.
And I said that the way to solve it, if you remember, was to have an advertising campaign that changed the perception, because perception is reality. Now, being serious about it, there are the transformers, the disruptive businesses like an Uber and an Airbnb, the two favorite examples at the moment. At the other end you have the zero-based budgeters, and in the middle you have the activist investors. They are perceived as being short-term. We had a session...
And some of them are.
Yes. And we had a session here at the International Business Council where you heard from Larry Fink, who has further ideas. You know, he writes to chairman of the S&P 500 every year,
right,
telling them what he thinks they should do to focus on the long term. He's got some new thoughts coming out, one in particular that he's going to develop, but that will come out in time. And obviously, the long-term institutions are worried about long-term health of the business. You know, you asked the previous interview, Chuck from Cisco, whether people are investing. Capital investment is down. We talked about that on your panel.
That's right.
And companies are not investing for the future. They're taking a short-term view. And the other thing I said was that the structures that go against good corporate governance, those where you have Git, so Rupert here. I think Rupert and the Murdoch family can take a long-term view, because their shareholding, you know, it's geared. They have a disproportionate control of the votes. I think that's a good thing. I mean, obviously, if the people in control are not good, you're in trouble. But having said that, it gives them the ability to build for the long term.
And not be forced to be under pressure situations.
Absolutely. And everybody's frightened of making a mistake.
Let me ask you about one pressure situation, because there was a lot of talk yesterday in the market, speculation, that Twitter could become a takeover target. What's your take on social media right now as it relates to advertising and your business? Do you think Twitter will get acquired?
Well, interestingly, our business with Twitter last year went up from about 150 million, I think I'm right, to 225 million. We did 4 billion with Google, 1 billion with Facebook. We did about 2.5 billion with Fox and with News Corp. The average for what I would call legacy media owners is about 750 to 1.75 billion in our media portfolio of about 80 billion. So that gives you rough orders of magnitude. Twitter obviously is going through a tougher time now from a share price point of view. Actually, from our usage point of view, as a PR, I think it's a PR medium rather than necessarily a branding, or certainly not a search medium. But from our point of view, actually we've strengthened our position and we're using Twitter more effectively
It is effective,
than before. So from a real business, this might be another example of the disconnect of the markets from the real world. But you're seeing a lot in the media industry. You know, is Netflix worth 50 billion? Some people say yes. Peter Chernin said
is Uber
yes.
worth 70 billion?
Well, depends whether there's something going to disintermediate Uber itself. But then the other thing is, you know, is Viacom worth 15, 16 billion? Is CBS, so there are a lot of questions being asked about the valuations. And one of the things the markets may have got wrong, I was talking to one or two hedge fund managers here who see value in the linear TV companies whose stock have been knocked. Time Warner. You know, Rupert did make an offer for Time Warner. It's now underwater to that price, even on an adjusted basis, given the Fox share price.
So is it back in play? I mean,
back in play. So you're seeing big shifts. But the answer, there's one other thing that's interesting. There are a few people starting to say that because of problems of measurability, robots, and things like that, automated viewing, that maybe traditional media offers better value than we think. So there's some interesting thing at the margin. It may be going back the other way.
Martin, good to see you.
Thank you.
Martin Sorrell, we'll be right back.